Next week could very well determine how crypto and altcoins perform for the rest of 2025. We have a Fed rate cut decision and Powell making his remarks late next week amidst a government shutdown where data is scarce. How will the Fed lean? In this video, we're going to break down what is the Fed likely to do? Are they going to cut rates or are they going to not? How is Powell going to react? Will he be dovish or hawkish? And how does the government shutdown affect the likelihood of both chances? If you're excited to learn more, like and subscribe down below, and let's hop in to today's video. So guys, next week we have the second to last FOMC meeting of the year. The next one happens late in December, so not going to be super consequential for 2025. In terms of the Fed, this is probably the most important meeting for the rest of the year. So we've got the Fed meeting next week. What are they going to do? What is Powell going to say? We also have a government shutdown where we're not getting a lot of labor market data. We're only getting it from the private sources. And we also are expected to get CPI data on Friday. That's the Consumer Price Index. That will give us an idea of how inflation's doing. That data was actually collected before the shutdown. So let's dive into all these things and figure out what they mean. First of all, how has Powell been acting? Powell actually spoke last week where he was actually pretty dovish. He said some pretty dovish things. And so what do we mean by dovish? This basically means that he's not super concerned about inflation and that he's acknowledging that the labor market is weak. Remember, right now we're kind of in a bad news is good news situation for the labor market. If the labor market is weak, if it is hard for Americans to find jobs, that means the Fed is likely to cut rates. This is good for us. So bad news is good news. Let's have a look at some of the different quotes that we pulled, some of the more important ones from last week's Powell speech. Based on the data that we do have, it's fair to say the outlook for employment and inflation hasn't changed much. That's good because the outlook for employment and inflation caused them to cut rates in September. So if it hasn't changed, that means that they're likely to cut rates again. While official employment data for September are delayed, the evidence we do have suggests both layoffs and hiring remain low and that perceptions of job availability and hiring difficulty continue to ease. The labor market is continuing to show weakness, and we're going to show you the data later in this video that proves that. There's no risk-free path, tension between employment and inflation goals, the economy is on a firm trajectory, labor market remains in a low hiring, low firing doldrums. So Powell being very dovish here, acknowledging that the labor market is weak, but also kind of downplaying the sticky inflation that we're seeing. So I've actually got Richard Clarita here. He's a former vice chairman at the Fed. He's going to break down what he saw last week in Powell's speech. It's dovish. Have a listen.
Well, I do think, especially after hearing from Chair Powell yesterday, that we are going to get that cut. It's an early meeting this year. It's, I guess, October 29th, not in November, so just in a couple of weeks. And I would expect one more cut after that.
And so you heard from the former vice chairman that Powell is sounding dovish here, likely to cut rates in October, even likely to cut rates in December. But we'll wait before we speculate on that too much. So let's have a look at the data. Let's have a look at the labor market data. This is private data, so this is not coming from the government. This is some of the better private sources that we're getting. So ADP, National Employment Report, 32,000 private jobs lost in September. That's the weakest since 2023. Confirms cooling in job creation, slower wage growth. ISM Services PMI, this is an employment index, below 50 for the fourth straight month. That means contraction. Remember the ISM, above 50 expansion, below 50 contraction. So persistent contraction in services hiring, easing labor tightness. Challenger Grain Christmas job cuts. I still think that's a crazy name, but awesome. 54,000 jobs were lost in September. Q3 total, 202,000 jobs lost. That's the highest since 2020. That's highest since COVID. Elevated layoffs signals cautious corporate outlook. Rising labor slack. Chicago Fed labor indicators, flows tight, loosening in labor market. And then Revelio Labs, lower demand in wage postings. So we're seeing weakness in the labor market. And really what the Fed needs to see in order to not cut rates, to do anything other than cut rates, is show that the labor market is strengthening. In fact, this government shutdown actually works in our favor because they're not getting the BLS labor market data that they would need to prove that the labor market is in fact turning around. Yes, this private data is good. It gives them an idea, but it's not the gold standard. And so without that gold standard, they're kind of forced to kind of stay the path of more rate cuts. This is bullish. And I think Powell's going to come out and get dovish. So we're seeing a dovish Powell. We're seeing weakness in the labor market. So let's have a look over at the CME FedWatch group. We see a 96.7% chance of a rate cut and a 3.3% chance of no rate cut. So we're looking good there. The odds are in our favor for a rate cut, and this is good. We're moving in the right direction. Let's hope we see one in December as well. So what do we have that could possibly be of concern? What we have that could be of concern is that Friday's inflation data is hot. What do we think is going to happen if we get hot inflation data? Well, to be honest, the inflation data is already hot. We're already sitting at around 3%. And as we've said in prior videos, there seems to have been an unofficial, unannounced, at least acknowledgement that 3% inflation is okay for now. But really, regardless of what inflation data they get, I think they're going to cut rates. And the markets have already been pricing this in, really based on Powell's comments earlier last week. I've got Danielle DiMartino Booth. She's actually worked at the Fed before. Listen to what she has to say about whether or not inflation data could stop the Fed from cutting rates.
Well, I think the market that's running right now is actually the bond market. And that is in anticipation of the Fed lowering rates, regardless of what the CPI print says this Friday. And the markets have indeed priced in a full probability, a 100% probability, 99.9% probability that the Fed's going to lower rates on October the 30th, based on basically what Powell said. He pre-committed, which is very unusual for Powell because he's always data dependent. Well, as you say, in a data vacuum, the Fed is clearly being more cautious and leaning on what these alternative data sets are saying.
And so there you have it from a former Fed employee. Regardless of what happens with inflation later this week, the Fed is very likely to cut. And so I've got one more clip on this. I really want to hammer this home, build the conviction in you that we're very likely to see rate cuts next week. I don't want inflation data to scare you. So I've got Chief Investment Officer Cameron Dawson. She's over at New Edge. She's going to break down what she thinks is going to happen. It's bullish.
We think that they will cut in October, even if you get a bit of a spicier inflation print. They'll do all sorts of cartwheels to justify why they can still do that. It would just raise questions about whether or not they can go in December. But really important to note that we think that when we get into 2026, the new Fed, with the new Fed chair, whoever it might be, is going to gun for rates to be 3%, which means that you'll get the cuts kind of regardless of what the economic outlook is going to be.
And here she is talking about the new chair of the new Fed in 2026. We're going to do a separate video on this, but really the fact that Trump is putting in his own Fed chair in the middle of next year is a very bullish thing for 2026. And it's actually one of the reasons that I think 26 is going to be a very good year for crypto. I just did a very in-depth video 2 days ago about why 2026 is going to be bullish, why I believe the cycle has been extended. Go ahead and check that out. If you watch it through to the end, you'll be a much better investor, probably more informed than 90% of retail investors. But as for this video, it's likely the Fed is going to cut rates. CME Watch Tool at over 96%. Former Fed employee, former Fed vice chairman, chief investment officer thinks they're going to cut, and many more. I've been watching these videos all week. Everyone's pretty much in agreement that the Fed's going to cut. We'll see what happens with inflation data Friday. It shouldn't be too out of control, but I don't think it's going to stop them either way. The labor market's weak, and it needs rate cuts to help it along. And we all need a little bit of help to get along in this crypto market. And so if you don't have the time to pore over these YouTube interviews, you don't have the time to pore over the data yourself at home, make sure you like and subscribe to the channel down below. We do the hard work for you. I'll be here almost every day, keeping you up to date with the macro, with the data, helping you become a more confident, patient, and knowledgeable investor. And so that's it for the day. Leave a comment down below. Let me know if you've learned anything. As always, thank you for being here, and we'll see you in the next video.